Look at these names for a second. Micron Technology, Lam Research, Comfort Systems, Javel, Halozyme Therapeutics, Modin Manufacturing, Nvidia, Tapestry, Carnival, and Western Digital. These are the top holdings of a brand new ETF that most investors haven't even noticed yet. And once you understand why these companies are grouped together, this ETF could completely change how you think about growth investing. Now, here is something important. These holdings are updated every single day. This is an actively managed ETF, which means you are not logged into yesterday's winners. The snapshot you are seeing is the one I pulled while creating this video. And what really impressed me is that over several weeks of research, I watched the holdings and weightings shuffle almost daily. When Western Digital started performing strongly, it jumped to the number 1 position. Then Lam Research took over the top spot. And at the time of recording this video, Micron is sitting at number 1. Different leaders at different moments, but the idea never changes. This ETF constantly repositions to capture where growth, demand, and momentum are strongest, with one goal in mind: maximize long-term returns. So what is this ETF? It's called CTEF, the Castellan Targeted Equity ETF. CTEF is built around a simple but powerful concept: identify the leaders of growth early and rotate fast. Instead of guessing which stock will win next, CTEF uses active management and quantitative models to continuously adjust its portfolio, so the strongest growth names naturally rise to the top. This is not a passive ETF, not a closed index fund. It's designed to actively pursue growth opportunities wherever they appear. CTEF launched in June 2025, making it very new in the ETF world, less than a year old at the time of this video. Unlike passive ETFs that track the S&P 500 or Nasdaq, CTEF is actively managed. That means real portfolio managers supported by quantitative models are selecting what to own, how much to own, and when to rotate. The goal is not to mimic the market, but to outperform it over time. Some key facts to know: the asset class is equities or stocks. Typical number of holdings ranges from 30 to 34 companies. Expense ratio is 0.45%, which is modest for an actively managed strategy. It focuses on US listed companies across all market caps. The objective is capital appreciation, so this ETF prioritizes growth, not income. Here is where CTEF really separates itself from other ETFs. This is not a passive closed indexer. CTEF uses a proprietary active methodology combining fundamental research and quantitative tools to find companies showing three main things simultaneously: growth at a reasonable price, GARP, companies that are growing earnings but not trading at extreme valuations; value signals, stocks that are undervalued relative to their future growth potential; momentum and earnings strength, companies already showing market recognition through upward price trends and strong financial performance. In plain English, instead of blindly tracking a benchmark like the S&P 500, CTEF's managers actively seek companies that are growing earnings, trading at reasonable prices, and showing upward momentum. This is a classic factor-based approach, blending value, growth, and momentum. Research has shown that combining multiple factors can improve long-term risk-adjusted returns compared to relying on just one factor alone. Additionally, there is an options overlay component as well. When market conditions are favorable, the fund may use strategies like covered calls to enhance returns on certain positions. So this is not boring passive indexing. It's a proactive conviction-based portfolio with a disciplined rule set. Now let's talk about the holdings again and why they look so diverse. CTEF is not a sector ETF. It is not a theme ETF, and it's not restricted to technology, healthcare, or any single industry. The fund's focus is momentum and fundamentals, not sector levels. If semiconductors are leading, CTEF will rotate heavily there. If consumer discretionary, industrials, or healthcare start outperforming, it can shift there immediately. That's why you see a mix like Micron, Nvidia, Lam Research, which are tech and semiconductors company. Then you can also see Comfort Systems, Carnival, Tapestry. These are industrial and consumer discretionary. Different sectors, different business models, same underlying signal, strong momentum backed by fundamentals. The freedom to own any US listed company that meets the strategy criteria gives CTEF a dynamic edge over sector limited ETFs. Now let's discuss performance. CTEF is brand new, launched in June 2025, so it does not have a long historical record. But since inception through the end of 2025, CTEF has delivered roughly 33.6% gain. Let's go ahead and see how this ETF or CTEF is doing compared to other famous ETFs. So I'm using stockanalysis.com website here to compare 5 ETFs. So I'm comparing CTEF with VOO, QQQ, VUZ, and VZT. And then the comparison period will be the inception date or from the inception date of CTEF, which is June 2025. So here are the plots. We see for the CTEF, the growth from its inception till now is 40.94%, which is huge compared to VOO, which is just 16.83. If we look into the growth ETFs in the same time, VZT gave return of 19.26%, VUZ 14.95%, and QQQ 17.96%. So we see CTEF is not only outperforming S&P 500 ETF, it is also outperforming the famous growth ETFs like QQQ, VUZ, and VZT. The key takeaway is CTEF's factor-driven, actively managed approach shows the potential to keep pace with or even outperform traditional benchmarks during favorable market trends, while also providing exposure to shifts in market leadership. Reminder, past performance is not a guarantee of future results, especially for a new ETF like CTEF. Now let's talk about the risks. Of course, every investment carries risk, and CTEF is no exception. It has this risk of active management. If the manager's decisions don't work out, CTEF can heavily underperform. The next risk is concentration risk. It has roughly 30 to 34 holdings, which mean individual stock moves impact performance more than in broad ETFs. There is momentum risk. Momentum strategies can experience whipsaws during market reversals or sideways trends. Sector exposure risk. Because the ETF rotates freely across sectors, it may lean heavily into one area, increasing drawdowns if leadership falters. There is this track record risk. This is less than a year old. CTEF hasn't yet been tested across multiple market cycles. So think of CTEF as a satellite growth position, a complement to a core portfolio, not a replacement for broad ETFs like VOO. Now, the question is, who should consider CTEF? It should be considered by growth-focused investors seeking actively managed high-conviction exposure, those comfortable with higher volatility and short-term swings, investors wanting a systematic factor-based satellite ETF to complement core holdings. Who might want to avoid CTEF? Investors who rely on steady income or dividends, highly risk-averse investors, anyone looking for broad market diversification alone since CTEF is concentrated. To conclude about this new ETF, CTEF is fresh, flexible, and actively managed. It's designed to capture the leaders of growth wherever they emerge, regardless of sector, theme, or market cap. With holdings like Micron, Nvidia, Lam Research, and companies across industries, this ETF is about momentum and fundamentals, not trends or hype. If you are looking to add a proactive, conviction-based growth position to your portfolio heading into 2026, CTEF is definitely worth a closer look. So here is my question for you. Are you adding CTEF to your watch list for 2026? Drop your thoughts in the comment. I would love to hear your take. And if you want more detailed breakdowns like this, hit that subscribe button and stay tuned. We will continue digging into ETFs, stocks, and strategies that could define the market this year.